Hello folks, and welcome to our April 2025 Market Chats video. I'm Rodney Hathaway, Chief Investment Officer here at Waukesha State Bank Wealth Management. We had originally planned on discussing budget deficits with you this month, but once again, we've decided to push that topic off for another month. Recall that we discussed tariffs with you in the March video. Budget deficits, trade deficits, and tariffs all go hand in hand. However, with the most recent market sell-off, we thought it was more pertinent to talk about portfolio positioning. The uncertainty around the tariff policy has been the main culprit behind the most recent market sell-off. Year-to-date, the S&P 500 index is off over 10% and is off over 14% from the high watermark that was established on February 19th. It's difficult to predict whenever the market may hit a bottom, but we can say with assurance that every market correction has always been followed with a full recovery. And in the most recent two market corrections, that recovery has occurred in 15 months or less, as you can see in the chart below. The first quarter of 2022 sell-off with the COVID-19 pandemic had a full recovery within 5 months, and the market made new highs by the end of that year. In the 2022 interest rate shock market sell-off, the market had a full recovery after about 15 months. So knowing that every stock market correction has always been followed by a full recovery, and again, considering the last two recoveries occurred relatively quickly, we think it makes sense to take advantage of when these occurrences happen. How do we exactly take advantage when these markets sell off, you may ask? First, you do your homework so you're prepared and so you can be proactive versus reactive when the event occurs. You make a wish list of those companies that you would like to own, companies that are in leading market share positions, companies with the blue chip customer bases and best in breed technology. Often these companies are trading at perfection and premium valuations. However, when the market sells off, suddenly these valuations come into a much more reasonable range. Whenever buying an asset of any sort, consumers always weigh the pros and cons of quality versus price. Take, for example, buying furniture. You can either go with a brand like Ethan Allen or a brand like IKEA. If you purchase a piece of Ethan Allen furniture, you're going to get something made out of solid wood that has high craftsmanship. And you expect that piece of furniture to last a lifetime. On the other hand, if you buy something made by IKEA, most likely it's going to be made of particle board. Its joints will be attached with screws versus a high quality dovetail joint. However, that piece from IKEA is going to cost you in the hundreds of dollars, whereas the Ethan Allen piece will be in the thousands of dollars. Once you've made your homework or done your homework and come up with a game plan, when that overall market goes on sale, you can then decide, okay, do I want to buy that piece of Ethan Allen furniture now that it's on sale? But before you move forward with that decision, there's one other factor you have to take into consideration, and that's the overall macro environment and whether it's conducive at that time for making the investment. While we never quite know the catalyst that might be behind consumers and investors getting nervous to create the sell-off, we can safely assume that we get one at least every few years. And when these events occur, they may not always seem rational, which points to the importance of understanding the underlying health of the market and the economy. If we dissect the events of over the last 90 days, what do we conclude? We entered the year on fairly solid economic footing. We were seeing some signs of slowing, but we were still in growth mode. The chart below shows that corporate earnings growth is expected to be solid for the next few years. Now you might refute this by saying, Rodney, things have changed drastically though just in the last few weeks. And yes, things have changed on the margin, but remember, the U.S. $29 trillion economy does not turn on a dime. In fact, while consumer sentiment has been impacted near term by the uncertainty, remember, things don't come to an absolute stop either. Last I checked this past weekend, people were still going out to eat at restaurants, retailers were still making sales, and factories were still producing output. Obviously, if trade negotiations come to a standstill, an outright trade war could curtail growth and potentially lead to a recession. We're currently taking the guidance, however, of the Trump administration at face value. According to President Trump, the U.S. is in current negotiations with all of our major trading partners, and they fully expect that a deal will be announced. We don't expect these deals will be perfect, but we do expect the U.S. will get major concessions from the EU, Japan, Canada, Mexico, South Korea, and yes, ultimately China as well. Remember, the U.S. is the net buyer with virtually every one of our global trading partners. Therefore, the negotiating power is in our hand. Execution of any new deals will take time to implement and very well may need congressional approval. However, the announcement of the deals in and of themselves should give investors and companies the confidence to move forward with capital allocations. Admittedly, the stock market volatility we've seen over the past month has been self-inflicted due to the Trump policies. However, as we outlined earlier, we came into the year on fairly solid economic footing. We therefore expect a quick and full recovery back to the original baseline assumptions for 2025 once we get resolution out of Washington. Predicated on this expected full recovery, we have been busy repositioning client accounts over the past couple of weeks. We've upgraded certain holdings and have purchased some of those companies that have been on our wish list. With the recent sell-off, we also feel more comfortable with the overall risk to reward ratio of the market as compared to where we entered the year. Those client accounts that had some excess cash in them, we have also used that cash and deployed that into the market here recently. We hope this chat has given you some insight as to how we view these occasional market sell-offs and how we can actually use them to our clients' advantage. As always, we welcome any questions and discussion in the future on this topic or any others. Thank you.